when we get into some future episodes, we may choose not to record, for different topics. But for today, we'll record. And so I got a PowerPoint that I'll share with you guys as well. And let's see. Boom, boom, boom,
I
boom.
haven't done the first one.
Here we go. Here we go. Perfect. Awesome. Okay. All right. We got Alec with us. Hello there.
Hello, hello.
Good to see you, man.
Good to
All
see you
right.
too.
Okay, guys, let's go ahead and get started. And so welcome to our second call. I'm excited, as I think about, these calls kind of scaling and growing over the next couple of years and what this could build towards. I think we're just kind of laying the groundwork and I'm just, want to share some real basic stuff, that I think could be really valuable for some of you guys. Some of this stuff may be review, and for others it's brand new. Um, I'll just encourage you if it's something that maybe you've heard before but maybe haven't done before. You guys know it's the old adage of it's not always learning something new; it's remembering something true. And so some of you guys are also mentoring other people or will be mentoring other people. So this is just good stuff that you can have in your back pocket that you could share to other people as well if it's something that you already have in place. So. First, let's just get started with any hot financial news or any updates that anyone wants to share financially. Yeah, obviously Roman with a 10K day, making some good coin in one day. That's a exciting kind of barrier breaker in terms of income opportunity. That should get you thinking bigger, for the rest of the year, I imagine. So, any financial hot news? I know I didn't prep you guys for this, but anything anyone care to share?
I got something.
Great.
Since last call, you mentioned setting up with holdings. So I went back to the basics and just put in some random numbers for some random withholdings.
Yeah.
Um, Forgot about it and I checked it today and it's at like $1,200.
Look at
And
that,
I've
man.
like paid all my bills. I haven't had to like check it since then. Um, so yeah,
That's
went back to the
awesome.
basics.
Yeah, good for you. That's big news there. Sometimes those automated savings. For me, when I first got started really saving significantly, it was saving in chunks. So it was bonuses that I would save, and then it was automated savings. So it was just taking the money out before it even hit my checking account. So those two things, is how I invested for probably the first 5, 6, 7 years of sucking money away. That was where most of it came from. So, yeah, great stuff, Roman. That's awesome way to take action on that, man. Anyone else have any hot news or financial updates to share? Alan?
So this is more like obviously I have a wedding that's next year, and so buying, spending for saving money for weddings a lot. And so my goal is to maximize my dollars that I'm already spending for this wedding. So I actually went to ChatGPT and I had it spit out like a credit card hack basically. Because I'm already saving the money anyways. I'm like, I might as well put the money in the credit card, pay the credit card off, and then get the points to be able to pay for my honeymoon. And it actually came out with a really good plan for me and Mads to be able to divert those dollars to get the maximum points. And we'll have our whole honeymoon paid for with first class flights actually on the way back as well too. As long as I save everything correctly and projections are right. So yeah, we feel pretty excited for it. We're already like, a third of the way there for saving. So
Unbelievable. That's so cool. Yeah, dude, it's like we find new uses for ChatGPT all the time, right? So,
yeah.
yeah, that's exciting to hear. We had I was actually just looking back on my notes for when I was prepping for this call this week, and I was looking back on some notes that I got from Justin Donald's Lifestyle Investor Group. Picking some things that I could share with you guys. And so, one of the speakers they had, several months ago was a credit card hack specialist. And so I was reading back through that and utilizing points and understanding the difference between bank credit card versus like Chase or, Bank of America or whatever, Chase or, Capital One or whatever versus like an actual airline card versus a hotel type card and, which points are most valuable and how to calculate and then like using transfer partners and, transferring, points from one, type of, uh, card currency to another in order to get the best deals. Pretty wild. I remember hearing this and thinking like, who the hell has time like to do this to try and save $100 and spend like, hours trying to learn this. But yeah, I guess once you really learn it, or you're able to use something like ChatGPT to just tell you exactly what to do, then maybe it doesn't need to take as long to save that kind of money. So that's pretty exciting. So yeah. It almost feels like it almost feels free because it's like money you were going to be spending anyway, and you're utilizing the points. So that's cool. Yeah, I booked a trip for the four of us back east to Philly using points recently, and was able to do like a card transfer, type thing in order to do it. So yeah, you kind of feel like you're cheating the system a little bit when you're able to figure out some of those deals. So it's pretty cool. Good stuff, Alan, and that's exciting. Cool. Who else has any financial hot news or updates that they want to share? Any others? Okay. All right. Well, we will go ahead and get started. Hey, Nick, Danny, didn't see you guys there. Good to see ya. All right. So I'll just start with a little bit of just kind of current events, guys. You probably heard in the news, all about what's going on with tariffs. You may or may not, be up to speed on that stuff. But here's what I'll tell you. The market in general responds largely based on one word, which is certainty. And so when you have certainty in the market, businesses can predict how policies will impact them or will be enforced or not enforced. And so it allows businesses to confidently invest in expansion or new factories or hiring more workers or things like that. So when there's certainty in the market, yeah, you usually see the market go up. It's also one of the reasons why when you see Congress split, like the House is Republican and the Senate is Democrat, or you have a Republican in the White House, but the House is Democrat. Like when you see a split, okay, oftentimes the market actually responds really positively to that because it essentially says, okay, nothing's going to happen. Like there's not going to be any like drastic changes, right? That we can't predict because there's checks and balances that one will hold the other back from doing anything crazy. Does that make sense? So anytime you see like a split, government, oftentimes there's a little more certainty that nothing crazy is going to get passed, so businesses feel more confident expanding, and investing into their growth. So right now, there's a lot of uncertainty in the market right now. Okay, and that's because the current government has implemented all these tariffs. Now, here's the thing. So what is a tariff? It's basically saying, okay. We are going to charge kind of a tax on bringing goods into the United States. So, and the problem with that in terms of pricing is that a lot of our goods come from overseas. And even if it's just parts, right? Or even if something's assembled one place, but you get the parts from somewhere else. And so when we, it was called Liberation Day last week, is when all these tariffs were announced, and you saw the stock market completely just take a nosedive. All right, and then what happened after that? Okay, is then the government said, "Oh shit!" Right? Like, what did we do? Right? And well, maybe then you heard like some prominent business leaders that kind of criticized the wide scale of implementing this so quickly and so steeply. And so they said, okay, we're going to put a pause on the tariffs. And then you saw the stock market skyrocket back up. Okay. So here's what happened. Anybody who took money out as it was falling, okay, or anybody who sold stocks after it was tanking, they didn't get to ride back up the next day. So that's, it's one of the reasons why, panic selling is never a good idea. Okay. And really what your philosophy should be is, hey, if things look like they're going down, then I just need to put my foot on the gas pedal and invest even more as it's going down. Because then as it rides back up, you'll make up those gains, if not even more than that, right? So the key is, you're constantly investing, through the ups and downs, right? And then it's called dollar cost averaging, right? And so as long as you do that, you're not going to miss the big swings up, by trying to avoid the down, right? It's almost impossible to predict, when, the days are going to be that it's going to be down or up, right? Nobody can predict that. I think the stat is like 90 some percent of all hedge fund investors don't beat the market, right? So it's like if these people with the highest, technology and these quants that are working for them and all these all high, best technology and the best trained minds in the world, 90 some percent of them, 95% of them don't beat the S&P 500. So what, like we think that we're going to be able to beat the S&P 500 when we're not trained quite as well, not nearly as well with nearly as experience or have the access to the same technology? Of course not, right? So it's when it comes to stock market investing, best course is just continue to pour money in and be consistent in terms of your investing, right? So yesterday the S&P hit what's called a death cross, which sounds very ominous, of course, but essentially what it means, it's essentially when the long term, uh, I get it's very all right. So how do I describe this in simplified terms? Essentially, like there's there's tracking of like a 6 month and a 12 month returns, and essentially when aligned for uh, projections of forward moving crosses back down over the trailing, it's considered what's called a death cross. And essentially, what that means is typically the market goes down after that happens for a period of time and then it shoots back up. We don't know how long it's going to take. We don't know that it's definitely going to go down. But what that means is that the stock market essentially is going to be on sale when that happens, right? So you're able to buy stock prices or index funds at a cheaper price than you would have before that happens, right? So for all of us, what does that mean? Just means don't take your foot off the gas and continue to pour money in as the market is going ups and downs because you don't want to miss those ups, right? So anyway, I want to talk a little bit about calculating your net worth. And so this is one of the first steps to becoming financially free, right? Is understanding how to track your net worth and doing a good job of it. Now, when I was a newer, rep and manager in the company, I was almost avoiding calculating my net worth because I was like, this is not going to be pretty. It was more, there was more obligations and debts and liabilities than there were assets at that point, right? And so when you are doing that, even if it's a negative net worth when you first get started, that's okay. All right. So, but the whole point is you got to have some kind of tracker to be able to show you where you're at so you can measure your gains each year. And it's probably even a good idea to every month just take a look at that and where you're at. Now, the great thing right now is there's a lot of free tools and trackers that you can use to calculate your net worth. So I'll give you a couple. Personal Capital is one that helps you track your net worth. Personal Capital is now they rebranded. I think they were bought by Empower, Empower, now owns Personal Capital. That's a great one. They have a free tracker that you can use. I will give you a heads up that sometimes they will have a financial advisor from Personal Capital or Empower follow up with you after you've used their free tracker to then try to sell you on their advising services. And you can just politely say, no, I'm good. I'm just going to use the free tracker. And they'll say, cool, and they'll leave you alone. So that's totally, that's a great one, Personal Capital. Another one is called Kubera, Kubera. That's the one I use currently. That one's not free. But it's cheap. It's, like less than $100 a year or something. But I really like the way that one works. Kubera, Kubera. And another one that I recently got exposed to that I haven't used yet, but I'm going to look at is called Visor, Vyzer. And the reason why I like Kubera and Visor in particular is because they also track alternative investments, not just not just stock market. So, like for instance, if you have real estate, holdings, or you're in a syndication and they're paying you with K1s or things like that. These will also track those. All right. So, and you can also track ROI over a period of time. You can compare what an investment's pro forma was. Pro forma is basically what's saying, hey, like this is what our projection for this investment will be over the next 5 years, and here's what you can expect as a return. That's when, that's what they advertise the investment with. And so if you want to track the actual performance compared to their pro forma, and say, hey, were they on track? Like, did they meet their pro forma? Were they under? Did they overperform? Right. So some of these websites will help you do that. That way, like, okay, do I want to continue doing business with that operator, or do I want to, invest elsewhere, for other money, right? So, okay, so those are some of the trackers for calculating your net worth. So how do you do it, right? Well, one of the ways that you do it is you basically are just going to take a list of all of your assets. These are things that you own, whether it's stocks, bonds. This is also your bank accounts, right? So it's all of the assets that you have, minus all the liabilities. That's debt. So that would be like car loans, right? Or mortgages or things like that. So it's assets minus liabilities equals net worth, right? If somebody has student loans, that would be a liability, right? What else could go into the assets? Well, if you have like jewelry or your Rolexes or something like that, or any of that stuff, you could choose to add that into your assets. I don't choose to add that because I'm not planning on selling any of that stuff, so I'd rather not calculate that as part of my net worth. Does that make sense? Some people do, and that's fine. But like I will also say some people calculate, they add in like the value of their car. Well, I'm not going to sell my car because I need a vehicle, right? And if I sell my car, I'm going to need to use that money to go buy another car, right? So I don't use that as part of my net worth. Some people do if you want to get technical, but I like to say, hey, like my liquid net worth, right, is the way that I look at that. All right. Okay, so what I want to go into right now is I want to talk about classification of your business. And so, one of the questions that some of the people had from our last call was the difference between a sole proprietorship, an LLC, or an S Corp. What's the difference with taxes? How does that work? I know that some of you guys may already be an LLC or an S Corp. So, I want to make sure we go over this. And so I found a really good video that I'm going to play for you guys on this. And I want you to know that the tax code is kind of rigged in the favor of business owners and investors. And so, you know, the playbook for lowering your taxes is 10 times larger as a business owner. Okay. Now, I know as a, brand new Cutco rep or as we're 1099s, which is considered a sole proprietor. Okay. That's what a sole proprietor is. Becoming a business owner, meaning an LLC or an S corp, can make a huge difference. But I want to tell you that if you are just an LLC and you are taxed as an LLC, you get zero tax benefits from being an LLC. The only way your LLC gives you tax benefits is if you fill out a form to be taxed. So you elect to be taxed as an S corp instead of an LLC. Okay, so as an LLC, you can just say, "Hey, tax me as an S corp," and we'll explain what that means. And that's where you get a ton of tax breaks if you are taxed as an S corp versus a sole proprietor or an LLC. So, we'll talk about becoming incorporated here more in a second, and I'll go through. I got a bunch of good stuff on the PowerPoint to share with you, but the first thing we're going to do is I'm going to play this video. I think this guy does a really good job of walking through what the differences are between sole proprietor, LLC, and S corp. And so I would take notes on this if this is something that you're interested in, or if you're already an LLC, but you're not sure if you're using it properly. I thought this was a really good one. So I'll play this and you guys
All
can
right, so
check it out.
today we'll be talking about sole proprietorship versus
Can you guys hear that okay? Okay, let me just share sound.
LLC versus S Corp. Which one should you choose? In this video, we'll be covering everything you guys need to know about these three business entity types. We'll go over the pros and cons of each, as well as what makes sense for what situation. Now, as a serial entrepreneur myself, I have had sole proprietorships, I've had multiple LLCs, I've also had multiple S Corps. Now, I'll basically just share everything I know about each of these business types, and hopefully it can help you guys make an informed decision about which one to have. Now, if you do want to start an LLC or an S Corp, I recommend using a service like Northwest or InkFile to do this for you. I've never filed for an LLC or S Corp myself manually. I've always hired a service to do it for me. We will put links down below, so if you do want to support the channel and get the best pricing possible, you guys can use those links to set up your LLC or S Corp. So let's first talk about sole proprietorships. Okay, so this is basically a business structure with one single owner. It does not apply if there's more than one individual behind the company. And basically, when you guys first launch a business, you are automatically considered to be a sole proprietor, unless you decide to form an LLC or an S Corp or C Corp. By default, your business, whatever side hustle, whatever you're doing, it's gonna be a sole proprietorship. This means that if I go outside right now and I start selling lemonade, this business is considered a sole proprietorship. And this does mean that your personal and business assets are sort of joined together, right? There's no legal separation between them. So just know that whenever you start a business and start making money, whether it be washing cars, whether it be mowing lawns, having an agency, even starting a YouTube channel, this is automatically considered a sole proprietorship. So it's the default business entity, even though it's not an entity. Now, the advantages of sole proprietorship are that it's super simple and super cheap. There are no additional required filings, and it really is the perfect business structure for someone that has a side hustle or a hobby that makes some money. For example, if you're selling homemade crafts on Etsy and you're making maybe, let's say, $5,000 a year, then this would be perfect for a sole proprietorship. With a sole proprietorship, there is no double taxation, and as you'll see with sole proprietorships, LLCs, and S Corps, all these do not have double taxation. This means that your business doesn't need to pay taxes, and then whatever money you make from the business after that also gets taxed, right? That's not the case. Any money you make through your sole proprietorship, it passes on to your personal income tax filing, and you'll pay taxes that way. Now, in terms of the disadvantages, there's no personal asset protection for a sole proprietorship. So let's say you are washing cars as your business and you damage a car and the client sues you. Well, they can come after your own personal assets. So if you own a house, if you own stocks, stuff like that, they can come for that stuff. But for most people, it's not really gonna matter, and that separation is not gonna be super important. So then that brings us to the limited liability company, an LLC. This is a type of US business structure with one or more owners who are called members. It's going to offer the same benefits of a corporation, but with a much more simple management. So when we compare this to a sole proprietorship, an LLC offers way more protection when it comes to liability should there be any lawsuits. So an LLC is treated as a separate business entity from you, the owner. While the sole proprietorship, it's you, right? It's the same thing. So basically the LLC owns the business and all the assets, while the LLC members run the LLC. So if you have a business that could get sued, then I'd say an LLC is definitely something you should consider. Having that extra layer of security is one big reason why people love LLCs. I think that's the biggest main protection for an LLC. If people sue you, they cannot come after your own personal assets. But one thing to consider is, do you actually have any personal assets, right? If you don't, then maybe you don't need that protection. And of course, just like a sole proprietorship, there is no double taxation. This means that all the profit is taxed in a single filing, which is on your personal income tax filing. It's pretty simple to create and maintain an LLC, especially when compared to a corporation. There are no required board meetings, there's no directors or officers. It has a much more flexible structure, but there are of course some disadvantages to an LLC. It is more expensive to establish than having just a sole proprietorship. There are also filing fees, there's annual taxes, there's annual reports that you need to keep track of. You also may need certain permits or licenses to do business. You also may need to hire a registered agent. All these things things add to the cost of setting up your business. There's a lot more formal paperwork and things to, keep in compliance with. You do need an articles of organization, operating agreements in most cases, as well as other documentation. Setting up an LLC, it's not like super easy. Although if you use a service to do it for you, it becomes quite simple. There's also zero tax advantages with having an LLC. All the net income flows directly to your personal return and you pay taxes on that. But if you do want something that does give you some tax advantages, you can have an LLC and elect to have it taxed as an S Corp. There's basically a form that you need to file for that, or you can actually go ahead and directly form an S corporation. And that brings us to the next section. So an S Corp is basically a special type of corporation in the US that elects to pass corporate income, losses, deductions, credits, all that stuff to their shareholders for federal tax purposes. So to qualify as an S Corp, you must have a domestic entity. You must have only allowable shareholders. There can't be more than 100 shareholders, and there can only be one class of stock. Basically, an S corporation is a real corporation, whereas an LLC is more of a business entity, but it's very similar in the fact that any income you make passes directly to the shareholders, which in most cases is just going to be yourself and whoever is your business partner. Now, the main difference is that sole proprietorships and LLC members, they pay taxes on the entire business's net income. Whereas for an S corporation, you only need to pay the income tax on your share of the wages. So basically, if you start an S Corp, you'll pay taxes on the salary that you decide to give yourself. The IRS does require you to pay yourself a reasonable salary for the work that you perform. Whatever remains in the business after you pay yourself, that is going to flow to you as a distribution. And I know this sounds kind of complicated, and we're going to go into more detail on what this actually means. Let's say, for example, we have an LLC and we have an S Corp. In both of these companies, it makes $100,000 in net profit in a certain year. Now, with the LLC, we are going to get taxed on that $100,000. We're going to pay federal and state income tax. Since it's also self-employment income, we will need to pay that 15.3% self-employment tax. And yeah, that gets really expensive. Now, with an S corporation, let's say we make that same $100,000 net profit. What we're going to do is we are going to choose to pay ourselves a salary from that profit. So let's say we pay ourselves $40,000 as a W-2 salary. So you essentially are an employee of your own business, and then the rest of the money, that's $60,000, that is paid to you through a distribution. Now, here is where it gets really interesting. So for that $40,000 salary that you pay yourself, you need to pay federal tax, state tax, as well as that self-employment tax. However, on that $60,000 distribution, you do not need to pay the self-employment tax. You do need to pay federal and state taxes, but you save on that 15.3% as self-employment tax. As you guys can see, you can save a good chunk of money doing this. In this particular case, you'll save about $9,000 in taxes just by having an S corporation versus an LLC. And again, if you have an LLC, but you want to be taxed like an S corp, you don't need to dissolve your LLC and create another S corp. Instead, you can just elect to have your LLC taxed as an S corp, and there's a form that you fill. Now, an S corp also is a separate business entity, so you do get the same liability protection. And yeah, that sort of brings us to the disadvantages of an S corp. So the first is that it's more difficult and expensive to set up an S corporation. A sole proprietorship is free, an LLC costs some money, but an S corp costs the most. There are more fees, there's the annual report, you'll need a registered agent, and you also need to pay to run payroll. This usually costs about $50 per month. You'll also need a board of directors and corporate officers, although this is likely just going to be you if you are the sole owner of the business. You also need to run shareholder meetings, have stock, and keep meeting minutes. So yeah, if you're making over, let's say $50,000 in net profit in your business in a given year, it's going to make sense for you to either choose to go with an S corporation or an LLC taxed as an S corp. Both will be exactly the same in terms of how much you pay in taxes, but it's pretty complicated. There's a lot of intricate things about these things. So I definitely just recommend talking with a lawyer or accountant or someone that knows everything, knows your whole situation, and they can basically recommend the best business type for you. Again, if you want to create your LLC or S corporation or even C corporation, we'll leave links down below to InkFile as well as Northwest Registered Agent. Both of these can help you guys create your business entity for you. It's super cheap, 1000% worth it, and every single business entity that I have created for myself, I've used a service like these two. It basically makes sure that you file everything correctly, because trust me, you don't want to do the paperwork incorrectly because that's going to lead to a lot of future headaches. But yeah, that's basically an overview of the differences and pros and cons between sole proprietorships, LLCs, and S corps. I encourage you guys to do some more research about this, and with that research, you will be able to choose which type to have. Anyways, I hope.
All right. Cool. We'll stop right there. I thought he did a good job of explaining that, so that I figured I'd just play that for you guys. I've been an S corp for many years now, and it has made a huge difference. So what did he talk about? Well, you have a personal tax return, and then you have your business tax return, right? So is there more fees for being an S corp? Yeah, because you're paying for your accountant to do two returns instead of one. Does that make sense? A business return and your personal return. But because you're saving so much money on the self-employment tax, it more than covers what your fee is going to be for your CPA to handle two returns. In Arizona, the cost for filing an annual report is like $60 a year, so it's super cheap, and and it's really easy. They just ask you a bunch of easy questions, basically like, has anybody who's an owner in the business been convicted of a felony in the last 12 months, and different things like that, right? So it's pretty easy. It takes like 5 minutes, and then you submit it, and then that's it. So that's called your annual report. So that's really the only differences. Are just some paying for two different tax returns from your accountant. But then essentially you just work with your accountant to say, how much should I be paying myself as a salary? Okay, so here's my net income from Cutco. Let's say it's 100 grand. How much of that do I want to be paying myself as a salary? And then how much do I want to be taking as a distribution? You'll pay self-employment tax on the salary portion, but not the distribution. And as long as that, so essentially you want to kind of keep that salary portion low, right? In order to save on self-employment tax. All right. So you can pay yourself whatever, 30 grand a year, even if you're making 150 grand, total. Does that make sense? So it just has to be reasonable. And so that is how that works with that. The only exception for keeping your salary low is if you're trying to uh, improve your credit to be able to qualify for a home, right? Because you need to show a certain amount of income in order to qualify to be to for certain interest rates when you're buying a home. So just be aware of that. You don't want to like super lowball your salary if you're going to be buying a home in the next couple years, right? So just something to think about and talk to your CPA about. Any questions on this stuff? Alec?
Can you hear me?
Yep, we got you.
Um, yes. So yeah, I went through that last year, S Corp for the first time. And I remember my CPA mentioned that the withholdings portion, I guess, on paying myself was too low. Do you know like what are your withholdings for your salary essentially? Like what's that percentage look like, or is there a range that we should be kind of targeting?
Yeah, I don't know if it's a percentage. I pay myself 60 grand. I've been paying myself 60 grand a year for, the last 15 years. So that's, kind of just ballpark it, I guess, with that. But I would say anywhere between 30, 40, 50, 60 is probably fine, anywhere in there, to pay yourself as a salary. And then the rest you take as distribution. So, and that should save you plenty of money on the self-employment tax side of things. Um,
Well, what I mean is not necessarily how much I'm paying myself, but there's a certain percentage you elect in Gusto. I know I use
Oh, oh, oh,
Gusto.
oh. Okay, got it. I understand what you're saying. So yeah, that's a CPA question because it also has to do with some of your deductions and how many kids and things like that. So there's it's essentially what you want to be thinking about is if I so in Gusto, so is it Gusto or Gusto? I don't know. But
Just I don't.
yeah, so when here's how it works, right? So I'm just going to give you the steps here. So first, you would create your S corp or LLC and elect to be taxed as an S corp. Second, you would set up a business bank account for your business. Okay. And so you need that if you're going to be an S corp. Next, you would go to Gusto and you would set up payroll with them. And so you would set your annual salary with them and then tell them to run your payroll monthly. What they're going to do is they're going to take your gross pay. So let's say I'm paying myself 60 grand a year. Okay, so 60 grand divided by 12 months, that's 5 grand a month is basically what my salary is. So what they're going to do is they're going to take 5 grand every month from my business checking account from West Frank and Associates. They're going to pull it out every month, and then a few days and what they're going to do, they pull it out, they take the self-employment tax out of that, they pay FICA out of that, so they pay the taxes, and then they take my net pay and they deposit it back into my personal checking account. Okay. So they take it out of my business, they tax it, and they do the withholdings for me, and then they put the rest back, the net pay back into my personal checking account. So most of those, Alec, unless you have elected withholdings on top of FICA and on top of self-employment, it would just be the standard amount that they're taking out of that. And if you want extra withheld, you could do that, but I would just do the minimum amount to, cover FICA and cover self-employment tax. So that would be a better question for CPA based on your situation, but that would be, yeah, I don't see a need to withhold any more. I'd rather not give the government a 0% interest loan throughout the year and then have them give me a refund at the end of the year. I don't want a refund. I would rather have the money sit in my bank account earning interest for me throughout the year versus sitting in the government's bank account earning interest for them. So I would rather have my withholdings set lower. And then if I need to come to the table with an extra couple $100 at the end of the year, because I didn't withhold enough, I'd rather have that be the situation rather than me just giving the government a 0% interest loan all year.
Okay, that answers my question because I was just confused because my CPA was like, "Oh, you withheld too little," and I'm like, "What?" I was just confused by that response. So I
It,
guess
you know,
that yeah,
So
that answered my question.
that might be more of a deduction situation where no, I didn't withhold too little. You didn't find enough deductions.
Yeah,
That might be the response to that, right? Like let's find some more deductions, right? So that because if it's the self-employment, that's pretty cut and dry. That's 15.6% or whatever it is. Like FICA is pretty set in stone. Like none of that stuff is negotiable, right? But the things that are negotiable is your deductions and what you can pull down your net pay to before it's taxable income.
and to kind of echo you, it's FICA and self-employment taxes. That's what they're withdrawing from, and then after that's the net pay to your
Yep.
personal checkings.
Yep.
Okay.
Yeah, you got it. So after you set up with Gusto, then the next step would be change your Cutco direct deposit so that they're paying your corporation's name and putting their direct deposit into your business bank account, not your personal bank account. Okay, so that would be the next step. So they would pay, Roman Earhart and Associates, right, and it would go into your business bank account. Um, and then the last step would just be, just understanding what those extra expenses are for the S corp, right? So that's filing the annual report, it's usually less than, whatever, $60 a year, takes 5 minutes. And then the extra expense for having your CPA handle two returns instead of one, a business return and a personal return. So that's that. Okay, cool. Any other questions on S corp or any of that stuff? Adam said, what's a guideline to follow for CPA booking fee for S Corp annually? Um, Mine does my business return for less than 2 grand a year. So just to kind of give you a ballpark, I know others that spend 5 or 10 grand a year, depending on the complexity of all the different holdings and assets and all the different, some people have their S corp and LLC that owns multiple properties and things like that, and then there's trusts and all kinds of stuff that people have to navigate through. But for mine, it's about 2 grand a year, just to give you a ballpark on that. All right. Uh,
Is that accounting bookkeeping too?
Sorry, you were cutting out a little bit. What was that?
Is that accounting bookkeeping?
No, I pay for bookkeeping separately. I do my bookkeeping through Rising Stock. Um, so or excuse, my books pro, through but associated with Rising Stocks. So they're pretty cheap too. They're, $100 a month or whatever it is for that one. So good question. Some CPAs offer bookkeeping service too, but mine is separate. Okay, let's go back to the PowerPoint here, and so I want to walk you guys through. I don't know if you guys can see this. Okay, do we need to blow this up a little bit? Okay, so let's go through just 7 finance rules that I want to go over. First one is the 50-30-20 rule. So this is a good rule of thumb that as you take money in, 50% of your expenses should go towards needs. That's food, rent, cell phone, things like that. 30% towards wants. So that's vacation, concerts, new car versus used car, something like that. And then 20% would go to your goals, which would be savings and investments, right? So that's kind of a good rule of thumb to say, okay, am I at the point where I can have, 50% of my, income that's going towards needs, 30% towards wants, 20% towards savings and investments, right? And so you may need to say, hey, maybe that means I need to make an extra 10 or 20 grand a year. I got to ramp things up in my business in order to meet this, right? So we have a lot of people, especially when they're newer and getting their feet underneath of them, that 75 or 80% of their income is going towards needs, right? Because a lot of that stuff is just stable year in, year out. But if they're not at that level, if they're only a little bit higher than that, in income, then obviously a much higher percentage of their money is going towards needs, right? So you got to get to the point where your income can support where only 50% of that is going towards needs and you can save 20% plus per year. So the next is the 4% rule. So the 4% rule basically says you can take out 4% of your investments in retirement every year in retirement without worrying about that money ever running out. Okay. So if you have $1 million by the time you retire in investments, that means you could take out $40,000 every year without worrying about that money running out. Okay. So if you have $2 million saved, then you could take out 80 grand a year without ever worrying about that money running out. Okay. If you got $4 million saved, you could take out $160,000 a year, right? And that's the 4% rule. Okay. The next rule is called the rule of 72. The rule of 72 says if you take the number 72 and divide it by the average interest rate that you're earning on your money, that will tell you how many years it's going to take for your money to double. Okay, so if you're getting an average 10% return, which has been the stock market average over 40-year periods, 72 divided by 10, that means that every 7.2 years your money doubles. Okay, so if you want to get to $1 million in net worth and you're averaging a 7% return, let's say, a more conservative return, that means your money's going to double every 10 years. So if you want to be a millionaire by age 50, then that means you need $500, or excuse me, 500,000 saved or invested by age 40. But it means that you only need 250 invested by age 30, right? We're subtracting 10 years, right? And we're taking the amount that we need and having it. Okay. So here's what that means, guys. So you need only, 250 saved by age 30, right? But that's only if you stopped investing after getting to 250 by age 30. Some of you are over 30 already and not at 250 yet. That's okay. You just may need to invest more after hitting 250, right? And of course, that's what most people do anyway. Most people don't stop investing after they hit that, right? So the question is, how quickly can you get to $125,000 saved? Here's what I mean. Because once you're at 125,000, you only need 3 doubling cycles, right? When you're at 125 doubles to 250, 250 doubles to 500, and then 500 doubles to a million. So the question is, how quickly can you get to $125,000 saved? Because then, even at a conservative 7% interest rate, in 30 years, that 125 turns into a million. And that's without ever investing more than the 125. That's if you invested the 125 and stopped. Okay. So it only takes 3 doubling cycles to get to 1 million at that point. All right. So is everyone clear on what that means, right? So it's basically the race to get that first 150, 125 invested. And then if you just let it sit for 30 years, you're going to be a millionaire. Okay. Now, obviously, the goal is to add more on top of that, right? And the goal is to continue, and hopefully your earning power continues to increase over the course of time. So then you're on track for 2, 3, 5, 10 million, right? You're not on track for 1 million, right? Because you're going to continue to invest beyond the 125. So next one is the 24/10 rule for car loans. So if you're going to take out a loan for a vehicle, you don't want to you don't want to buy a car unless it fits this metric. A car that you can afford to put 20% minimum down payment, a maximum 4-year loan, and the car payment is no more than 10% of your gross monthly income. Okay, so you want to find a car that fits that. Now, we have lots of college age kids that are buying cars that are way beyond this and they're overextending themselves on a car. It's really hard to save a bunch of money and invest when you're young if you got a lot of money going towards a vehicle or, towards, you know, um, yeah, things that they don't need to afford. They're overextending themselves for flash when they should be more concerned about investments, right? So I'll simplify it that way. Um, the 3 times rent rule. Okay, rent should not exceed 3 times a person's monthly income. All right, this is your personal rent should not exceed 3 times. Um, uh, sorry, let me backtrack here. Uh, the 3 times rent rule, 3 times the monthly rent rule says rent should not exceed 3 times a person's gross monthly income. So the idea is that housing should not consume more than a third of your income. That's an easier way to say it, right? So housing should not be more than a third of your monthly income, okay, to pay for your housing. Okay, next one is 3 to 6 months worth of living expenses in an emergency fund. And this is used for real emergencies, right? Like medical or vet bills or flat tire or something like that. So you want to try and save 3 to 6 months worth of living expenses. And then the last one is 2 times investing rules. So this is a great habit to get into. Anytime you buy something that's a want, can you invest that same amount? So if I'm going to buy concert tickets for $250, can I just throw 250 into S&P 500 on the same day? Right. So it's like, hey, if I'm going to buy a want, I need to also invest the same amount into my future me. Right. So that's a good habit to get into. And if you can't afford to do that, then you should reconsider that want purchase. Right. So something to consider there. Okay. Uh, the next one I'll show you guys is the risk reward map. And so this is kind of like the continuum of different types of investments, right? On, going from risk level and reward level, right? Higher risk, but potential for higher reward. So of course you got things like crypto on the very top, and penny stocks, options trading. Then you got VC and startups and angel investing. Then you got ETFs. Buying on leverage. You got individual growth stocks, and then real estate flipping, peer-to-peer lending, REITs, which is basically like a mutual fund for real estate. Stock index funds, right, is a lower risk level, right? Dividend stocks, bonds, high yield savings account, certificate of deposits, and then treasury bonds and T-bills. So, that's kind of like the range of risk, right? When it comes to the different types of investments. Okay. Um, so that's that. I wanted to talk about the 6 different types of IRA accounts. We're not going to talk about all of them here. We're going to talk about some of the main ones here. So traditional IRA and Roth IRA, these are the biggies, right? So essentially what this means is that a traditional IRA is taxed when it is you get a tax deduction when you put money into a traditional IRA. So the limit for this year is 7 grand. So if I put 7 grand into a traditional IRA, I can take a $7,000 deduction on my net income this year. So I'm paying taxes on $7,000 less. Okay. So I can take a deduction for the money I put into a traditional IRA. What's the catch? The catch is that I have to pay the taxes on that after I take that money out in retirement. So when I take that money out, it is taxed at that point. Okay. So that's the traditional IRA. A Roth IRA works the opposite. I pay the tax on it now, meaning I don't get to take a deduction for putting the money in right now, but it grows tax free. So it gets bigger and bigger and bigger. And then when I take that money out in retirement, it's already been taxed when it was a seed. So I don't have to pay tax on it when it's a forest. Okay. So that's the Roth. Okay. So that's the concept there. All right. So, so those are the two that I really just want to make sure we hammer there. Self-directed IRA. This one is important because if you want to invest in alternative investments, so let's say you want to do a real estate deal, or let's say you want to invest in, I've been doing private lending deals where I loan money to a real estate flipper and then they have my money for 6 months and then they pay me back after 6 months, my principal plus 15% interest. I'll take those deals all day long, right? You know, a 6 month deal, 15%, that's a 30% annualized return. If I do that twice a year, I'll take that all day long, right? So that, but I do that out of a self-directed IRA account. Okay. So think of it like this: anything that and I do it out of a self-directed Roth IRA account is the way that I do those deals. So any investment that already has tax benefits in the investment, you can do outside of a retirement plan. So you can just do it from your personal checking or something like that. So I invested in an oil and gas deal a couple years ago, and that already had some tax benefits built into that type of investment. So I wasn't going to do that out of a Roth account. I was going to do that just out of my ordinary income. Okay. However, there are other investments that, like for instance, these private lending deals that don't already have any kind of tax breaks built into the investment. So I'd rather do that out of a Roth account so that way I'm able to get the return on that. And so if I use Roth money, I invest in this, and then when they pay me back, they don't pay me back personally, they pay my Roth account back. So then I get all that money coming back that still grows tax free. So my return becomes tax free compounding as well. So that's why, when we say, hey, there's certain, based on the type of investment, you might want to do it out of a tax advantaged account or out of a non-retirement account. Okay. All right. So next thing we'll cover here, the Roth IRA limits value by year. So if you're just putting $7,000 a year into a Roth IRA, after 5 years, you've put in 35, but it turns into 42. After 10 years, you've put in 70, but it turns into 111. After 15 years, you've put in 105, and it turns into 222. After 20 years, you've put in 140 and it's 400. After 25 years of just putting 7 grand a year, you've put in 175 and it's almost 700 grand. 30 years, you've put in 210 and it's 1.1. And after 35 years of contributing to a Roth, you've put in 245 and it's almost 2 million bucks. Okay. And because it's a what? Because it's a Roth, you've already what? Paid tax on it. So that means what? That money is tax free in retirement. Okay. So that's the value of contributing to your Roth IRA consistently year after year. Okay. The S&P 500 performance over the core since 1980. Okay. So if you put $10,000 into the S&P 500, the S&P 500 is basically a mix of the top 500 most successful companies is basically the way US based companies. So the cool thing about the S&P is that if a company starts to massively fumble, okay, it will get booted out of the S&P and replaced with a better company. Okay, so it's kind of like readjusting, right? The S&P 500. All right, so the S&P is always evolving. So I'll give you an example. DoorDash, Williams Sonoma, those are two companies that are being added to the S&P this year, and there's a couple other companies that are getting taken out of the S&P this year. All right, so to become an S&P 500 company, they need to be profitable for the last 12 months. They need to be worth at least $20 billion. They need to be listed on the US stock exchange, and they need to be trading publicly for at least the last 12 months. So when you invest in the S&P 500, you're investing in a mixture of the top 500 companies. Now, here's the thing is that it's not even. So you're not evenly, when you put $100 into the S&P, you're not or let's say you put $500 into the S&P. It's not like $1 that goes towards each of those 500 companies. So it's not spread evenly. It's based on market cap, based on the value of the companies inside the S&P. So if you put 10 grand into the S&P, you're actually putting this amount into Apple, you're putting this into Nvidia, into Microsoft, into Amazon. So if you hear somebody say, "Oh, I'd rather pick my own companies rather than invest in the index fund," you're already investing in those same companies when you're investing in an S&P 500 index fund. The only difference is that you're hedging your risk, right? Because you're spread out between 500 companies. So, the Magnificent Seven, which are the big seven tech companies, okay, when those companies are crushing it, you're going to see a big benefit within your S&P 500. Maybe not as much as if you invested in those seven, just those seven individually. But what happens if, one of those seven, has a crappy day? Nvidia, it took a nosedive last week because, when we said that we were going to be putting tariffs on all of these imports of AI chips and manufacturing. Well, 3 days later, after the stock market had already taken this big dive, the Trump administration said, "Okay, well, we're going to give some exceptions here to semiconductors and computers and some of this high tech stuff." And then Nvidia shot right back up after that exception was announced, right? So, okay, so anyway, that's the S&P. Warren Buffett. Here's what's interesting. Warren Buffett, known as one of the best investors of all time. Most of his major returns in his career were in the first 40 years of his career. If you just look at the last 20 years, his returns for Berkshire Hathaway have basically mirrored the S&P 500 returns. So even Warren Buffett isn't beating the S&P 500 right now, right? So just something to think about with that. So I'm going to play one more video here for you. I love this one. This is Scott Galloway. He's a great follow. If you haven't heard of Scott Galloway, I highly recommend. Guys, for time purposes, if you have to bounce, I won't take offense. This one's a little longer. It's going to take us a little over here. But I think this is a really beneficial one. So if you need to watch the recording for this, I understand, but I think you'll really like this. So this is Scott Galloway, How to Invest.
Let me make it easy. Go to Vanguard. I don't have a relationship with Vanguard. SPY. That's the index that tracks the S&P 500. Mm-hmm. And so the email I get most is from young men looking for guidance and mothers looking for guidance for their sons. The second most frequent email is the following: is it too late to invest in Nvidia? And the honest answer is I don't know. I can imagine a scenario where it gets cut by 80%. I can imagine a scenario where it triples. So this is what you do. You invest in SPY because about 20% on the dollar will go into the Magnificent Seven because they're about 20% of the market cap of the S&P.
SPY is, again, a basket of different stocks.
It's an index fund that mimics the S&P. So there are 500 companies in the S&P. Nvidia is probably 3 or 5% of the total value of the S&P. So 5 cents on your dollar goes into Nvidia, right? About 20%, is that right? 24, 25% is the Magnificent Seven, the tech companies we talk about. 25 cents on your dollar will go to them. So assume those companies double. Great, you participate. But assume the other 493 companies finally get their time in the sun and those companies go down a half. You're still fine. You're still fine. Again, you don't need to find the needle in the haystack and stop believing in a very American way that you can figure it out. I know the brightest people in finance. And what my net conclusion is that none of them have any fucking idea. Some have a little bit more of an idea. But if you look at the entire alternative investments industry, hedge funds, private equity funds, mutual funds, anyone on CNBC, if you took all of their returns in aggregate, they're less than the S&P by the amount of their fees. It's one of the greatest grifts in the modern economy is believing that some guy who looks old and unhappy and has suspenders and went to Harvard knows more about the markets than you. All you need to know is diversification, right? SPY, start saving young. And then the next best piece of advice is if you can, force savings. 98% of us will spend everything we get our hands on It is very hard to have the discipline to take money that is within your grasp and invest it. Forced savings plan. Find out at work if they have profit sharing or IRAs or Roths, whatever the I forget what it's called here, where if you put some money aside, the government matches it.
Pensions.
Well, not only pensions, but there's something here, I forget what it's called. If you save £5,000 through your work, the government, I think, will match it, put in £1,000. There's all sorts of saving schemes at work. Acorns, the apps that round up to the nearest dollar and then immediately shoot it into SPY. Try as hard as you can to put yourself in a position where you invest despite your best efforts not to. Because the majority of us will get that money and go buy a flat screen TV.
And when you're saying investing, I think because it can sometimes sound complicated from someone that's so far away from it, there's apps on our phones now where we can, in a couple of minutes, invest in the exact thing you've just said. We can make an account in a couple of minutes. I'll probably ask for our passport, take a photo of our passport. There's so many different apps where you can go in and invest in the S&P 500. You don't need to call someone or know someone, and you can invest. What's the minimum you can invest? $50.
$1. Go to public.com. Start with a basic low cost ETF or index fund. SPY. If you want to take a little bit more risk and you want to be in tech, there's all sorts of ETFs and index funds around tech. Every young person, especially young men, is under the impression they're smarter than they are and that they can beat the market. So, okay, take 30% of your money, have some fun, buy Starbucks, Nvidia, Unilever, Novo Nordisk, whatever you think you have insight into, so you can learn a life lesson that over the long term you don't know what you're doing, and just put it in an index fund. Because the marvelous thing about the human race is we become more productive, and the Western economies, generally speaking, over the medium and long term are up and to the right. And again, and I'll go back to my algorithm or equation, focus, find something you could be good at, maybe great, that has a 90+% employment rate. Stoicism, we haven't talked about that. Realize there's some things you can't control. Focus on the things you can control. One thing that is within your control is spending. Try and find a partner, try and gamify spending. I spent $78 a week my summer between my junior and senior year, including rent, because I needed $3,300 to go back to school. I partnered with 5 other guys in my fraternity, and we gamified who could spend the least amount of money. Find a partner who's aligned with you around spending and saving, right? Realize no one's as impressed or thinking about your shit as much as you are, right? Try and find reward from exercise, from relationships, not from signaling wealth with kind of stupid shit, right? I call that stoicism. It's really more about discipline. Develop a savings muscle. One, an appreciation for time and how fast it's going to go. I was stupid. I remember my best friend Lee Lotus picking me up to go to the beach when I was in college, and he was scrambling to find $2,000 to put it into something called an IRA Roth, where his company, a bank he was working for, he was just out of college, if he found $2,000, they would match it with another $2,000. I said to him these exact words: if $2,000 means anything to me when I'm older, shoot me. I have made so much more money than Lee Lotus, and he is a multimillionaire now, so am I, but I've endured a lot more risk and a lot more ups and downs because he was that lame guy scraping together $2,000 when he was 23. I went out and spent my first bonus check at Morgan Stanley. I got $28,000 my first year out of college, Morgan Stanley. $28,000 check. I go out and I buy a $35,000 BMW, hung swim goggles from the rear view mirror thinking that would impress people. I don't know what I was doing. I figured out if I had bought a Hyundai for $9,000, which you could get in 1987 or whatever it is, and invested the other 20 in SPY, never looked at it again, I would have enough money now to buy 11 Ferraris, including that new electric Ferrari that for some reason appeals to me, which makes no sense, an electric Ferrari. Anyways, you're going to love this. I tell the people that work for me that I drive up in a Ferrari and I say, if you work really hard, someday, I'll have 2 Ferraris. Anyways, I don't have a Ferrari, by the way. My other joke about a Ferrari is Ferrari's like having a long, consistent erection. I don't have a Ferrari. Anyways, where were we going? Realize people aren't as impressed with your shit as you are. Recognize the power of time. And then the thing where I really screwed up, Stephen, diversification. Take some money off the table. Invest in, I'm hearing from employees at NVIDIA, we talked about this, diversify. It's such a bulletproof Kevlar for your mental health. You get risk-free return. Nobody knows. Anything can happen. Amazon 1999, again, lost 90% of its value. Do you know the kind of mental anguish when you go into a stock like Amazon and you lose 90% of your investments? So if you want to have some fun, ring fence it to 30% of your savings, pick some stuff, and it'll be a good life lesson for you. You may get lucky, more power to you. Over time, you're going to realize nothing beats over the long term. Warren Buffett, what, the third wealthiest man in the world? I'm giving you the same answer he gives. If someone has $10,000, how do they invest? And he's like, low cost index funds.
It's a 2.5-hour conversation. That concludes it. Put it in the S&P 500.
Low cost index fund. I know it's the boring shit that makes you rich.
Yeah.
It's also, I advise a lot of CEOs, it's the boring incremental stuff that moves shareholder value.
Mm-hmm. No, it's so true. So one of the things that stopped me when I was young from doing exactly what you just said is I didn't think that the $500 I had or the £500 that I had was enough to get started. So I said to myself in my head, I thought, okay, when I get 1 million, I'll become an investor. And I think a lot of people actually listen to these kind of conversations and go, okay, once I've got £5,000 disposable income a month, then I'll do what Scott said. But there's no point in doing it with a small amount of money. I wanted to use this little bucket of sand here as an analogy for this because my team brought a bucket of sand to illuminate the power of compounding interest when you invest in these S&P 500 companies. And this glass represents investing 1,000 a month in the S&P 500 over the course of 12 months, starting at the age of 25.
Right.
But if you left it and kept investing at that rate, by the age of 65, it would look like this.
You have Zuma Beach. Oh my God. Thank God that's you.
Jesus Christ. It would look like that. And this is really what you're saying when you're talking about ETFs.
Well, you asked that question about the young man who says, I'm going to wait till I have 500 pounds. I'm going to wait till I have 1 million before I start investing. The way you get 1 million pounds is by investing that 500. We don't believe we're going to get old. We don't recognize how fast time is going to go. We don't appreciate the power of compound interest. Don't focus on your investments. Put it in low cost, low energy ETFs. Start early. You have time. Your advantage when you're young is time. And you're going to get that bucket of sand. By the way, this right here isn't a lesson in investing. This is a lesson in storytelling. A bucket of sand. I mean, who thinks of this?
Move it out of the way. No, but it is. It is. I discovered the art and the science of compounding interest too late in my life, and I just wish someone had slapped me in the face with it at 18.
Yeah, it's crazy.
And honestly, I probably started at 28.
That's still earlier than most people, but it goes to the notion of, back to the advice for a young person, most young people don't have the discipline to invest any money they get their hands on, because a capitalist economy is the smartest people in the world with the most godlike technology are presenting you with amazing, irresistible offers to upgrade from economy to economy comfort, to add flourless chocolate cake to your order from Balthazar Boulangerie in 1 minute or less. I'm like, oh my God. Oh, wait. There's 3 other people looking at this room, this hotel room, and it's going on sale, and I better buy. It's so difficult to hold on to any money. You want to find ways of forced savings. A house is forced savings to a certain extent because people don't want to be evicted from their house. Going to work for a company and getting options and getting equity that grows tax deferred, that's sort of forced savings. But you want, as a young person, try and find as many ways as possible to have forced savings. An app that rounds up to the nearest dollar and then invests no matter what, that is forced savings. It is very difficult to take money that ever comes through your hands and invest it. So find forced savings mechanisms that are taken out of your check. Find out if your company offers any sort of investment or saving schemes that they match or that the government matches. And most corporations offer something.
Real estate. I've had a lot of guests talk to me, like Morgan Housel and others, that have a sort of mixed view on whether real estate is a good investment. What's your thoughts on it? Should I be investing in real estate? But my brother said something to me when I was 25. He said, Steve, if everybody is playing the game, the returns probably aren't great from it.
It goes back to sex appeal, too much capital going in. Look, Case Shiller, the brightest people in real estate will say if you really account for maintenance and upkeep, that real estate has not outperformed other asset classes. The reason I like real estate is that, one, In the United States, it's very tax advantage. There are very few asset classes you can lever up 4 to 1. 20% down payment. I can't buy Apple. I can't buy $100 worth of Apple stock for $20. So it's huge leverage. The interest on that is tax deductible. In addition, if you sell a home, and this is true in the U.S., I don't know in the U.S., I don't know in the U.K. If you buy a home and sell it after, hold on to it for at least 2 years, you get a $250,000 tax deduction, $500,000 for married. So if you have, for example, any ability, get to know the homes in your area, find a nice home or a rental unit that you can maybe rent out or upgrade. Maybe you're handy. To do that every few years and take advantage of the tax deduction and then roll into something bigger. And that is forced savings. You know that mortgage payment is coming every month. Actually, the majority of savings for baby boomers right now is in their homes. It's the equity in their homes. Now, unfortunately, there's some bad things. We haven't improved housing permits as quickly as we should, which has made it more expensive for entrants. Young people can't afford homes. The average home's gone from $290 to $420 through the pandemic in the U.S. And if you look at interest rates, it means the average mortgage payment's gone from $1,100 to $2,300. So it used to be 2/3 of America could afford a home. Now it's 1/3. A whole other talk show, but I just did a TED talk on the war on the young economically. But real estate is a very tax advantage industry. It is forced savings. Also, there is some, I think, psychic value, which I think is important to a home. You start investing in it, fixing it up. It feels like, I don't know, there's something rewarding about it. But to what your brother said, when everyone's trying to buy homes in an area, that usually means it's probably getting overvalued. And like any other asset class, it can lose money. But the reason I like it is because it is a form of forced savings. People, generally speaking, will make that mortgage payment or try and figure out a way. Now, you want to make sure that not more than 40% of your income goes into a house. Otherwise, it's just going to be your anchor. It's just going to be a source of stress for you. And I think a lot of people grow up thinking, I have to have a home. And so they just become over levered in their home and they become kind of house poor. They own a house and that's it. And they can't afford to do anything else.
And they might be able to move then. And you talked about geographical opportunity when you're young.
That's right. You get tied. You get tied down, especially if your home goes down in value. But I still think it's in the U.S. at least, real estate's the most tax advantage. And if you own commercial real estate in the U.S., you can depreciate it 2 or 3% a year. You can't depreciate a stock 2 or 3% a year.
Is there someone that should and shouldn't buy a home then, in your view? Is there a certain demographic or age or person with a certain talent that should and shouldn't buy a home?
I would say in general, if it's a home, if you think that you're not going to be able to hold on to it for at least 7 years, if you hold on to a home for 7 years, you should be able to ride out most economic cycles or a economic down cycle. I think there's some wonderful things about renting. You can slam your keys down and leave. If you're planning to move, if you don't have somewhat reliable sources of income, a mortgage is probably a tough thing. I don't know. I think home ownership. I'm talking my own book a little bit here because I've made good money in real estate. I've really enjoyed it. But I think it's situational, and it goes back to that notion of having a kitchen cabinet of people who can advise you on that asset class. Unfortunately, that asset class has become so expensive that the quote-unquote American dream of owning a home has become somewhat of a hallucination, if you will, or a fantasy for a lot of young people.
If you love the Diary of a CEO brand and you watch this channel.
All right. So hopefully that was valuable to you guys. I really like Scott Galloway. He's got a lot of good stuff out there. And he's all over social. So I recommend taking a look at some of his stuff if you enjoyed that. Guys, for time purposes, we'll end there. I have some other stuff on my list, but we'll save it for another call. We don't currently, I don't think, have our next call in the schedule. So I will, or you know what, we might. We'll have to go back. Let me just double check. Yep, we do. May 15th, Thursday, May 15th, same time. Is our next call. So hopefully you guys found that valuable. I can hang on for another couple minutes if anyone has any follow-up questions or anything. But if you need to bounce, totally understand that too. So or we can just share any takeaways, guys, too. Anything that you got out of that? Any thoughts, questions, or takeaways?
Yeah, I'm curious, Wes, like what are some of your go-to platforms to invest in S&P 500 or any low index funds?
Yeah, either Vanguard or Charles Schwab. even Robinhood for that matter, you can just do, any of that is fine.
Cool.
Yep. Um, yeah, Robinhood's easy. So yeah, and you can just look because Vanguard has their S&P 500 index fund might be called a different ticker symbol than Charles Schwab's 500 S&P 500 fund or another one. So you can just look them up, based on which platform you're using, and just look up, hey, what's the best S&P 500 fund to invest in there. SPY is the one he was really promoting. Uh, that one is, uh, let's see, you can get that really, yeah. Robinhood will allow you to do it on there for sure for SPY and Fidelity. That's another one. So I would say Vanguard and Fidelity are probably the two most popular. If you're gonna do like a self-directed IRA or self-directed Roth, Charles Schwab is great for that, but Fidelity does that too. So.
And SPY, was that different than the S&P 500? That's like more the top seven kind of
No,
tech,
SPY
or
SPY is the S&P 500. It's
oh,
basically
okay,
yeah, so the S&P 500 is the mix of the top 500 companies that we talked about, and SPY is an index fund that mimics the fluctuations of the S&P 500. So if you're
gotcha.
investing in yeah, so if you invest in SPY, you're investing in the S&P 500. Good questions, Alec.
So, Wes, I have a question. What are your thoughts on financial advisors? When do you typically recommend somebody look at someone like that? And when it comes to having somebody manage your portfolio, obviously only 98% of people can't outperform the S&P 500. So where does the real value come from with a financial advisor if you're paying a percentage of your portfolio?
It's a great question. Here's what I would say. Um, a good financial advisor is more about emotional management than stock picking. And here's what I mean by that. A good financial advisor is really there to make sure you're diversified and to protect your losses more than maximize your gains. Okay? And what I mean by that is a good financial advisor will talk you off the ledge when you're thinking about pulling all your money out when the market's going down. A good financial advisor will make sure that you have a certain amount of money put into bonds and treasuries and other things, not just stocks. Now, when do I recommend that? I typically I say you don't need a financial advisor to invest 7 grand a year into a Roth IRA. You don't even need a financial advisor to do a solo 401k, and do that every year. Beyond that, if you're just putting money into an S&P 500, you don't need a financial advisor as long as you're disciplined enough to just set it, forget it, and not touch it and not screw around with it. Um, Many financial advisors, part of the money that they're investing for you is into the S&P 500 anyway. So why are you going to pay an extra percent or two to somebody compounding for them to do the same thing that you were going to do on your own? Okay. So now that's the purely math, argument. Okay. On the other side, it's just an emotional thing, right? It's like, hey, I just need somebody who's going to hold me accountable, or I need somebody who's going to make sure that I don't make any dumb decisions by pulling money out, when I freak out about the market. And there's value in that. So I like being able to talk through things. I like being able to sit down with somebody a couple times a year and say, here's where I'm at. If I continue on this track, here's where it gets me 5 years from now. Here's where it gets me 20 years from now. Like, to me, there's value there. So you could find a fee-based advisor who's willing to do that for, sit down and have those conversations for $500 a year, right? And so you could find somebody who's a fee-based advisor, or somebody who's relatively inexpensive, because of that. So I don't know. I guess I would say if you trust yourself to not screw with your investments and just keep pouring money in, then you don't need an advisor for that. But if you value being able to sit down and talk through it, and somebody's going to hold you accountable and say, hey, you haven't made your contribution to this account yet for the year, don't forget, right? Or hey, this is coming up, the deadline for this is coming up, don't forget. If there's value in that for you, then it's worth it, right? So I think it's an individual question. Do you need it for the actual investment? No, you don't. So, but there's other value that they provide other than just making the trade for you.
Gotcha. So the value comes from strategy and emotional management, essentially, and yeah, long term, and being able to talk through somebody with that. That's interesting. You mentioned fee-based investors, because I mean, you look at even 1.5% of your portfolio over the
It's
course of
huge.
10, 20, 30, 40, 50, 60 years. That's a crap ton of money. It's a crap ton of money. And again, if they're not, not going to be outperforming the market, it's just something to consider. I know you and I have the same financial advisor, Wes, and it's just like I pay a fee plus, a percent of my portfolio, but I never heard about fee-based or fee-based financial advisors before. And I don't know anything
Yeah,
about that stuff.
they exist. Whether they're better or worse, I couldn't tell you because that's not what I use. Like you said, I have a financial advisor that I find value in. Now, I don't have all my money with that, right? I have my stock market investing through that, but I have other investments that are outside of an advisor that are not paying a 1% fee on or whatever. I do my alternatives outside of that, but I have my stock market stuff with them.
Makes sense. Makes sense.
Yep. Great question. Any other questions, guys?
It's just me, Nick, and Alan on here now.
Yeah.
Everybody bailed. It's
Cool.
all gold. This is good stuff, Wes.
Good. I wasn't sure exactly, it's like going into each call, it's like there's so many millions of things you could cover, but it's like, all right, let's find, the right mix, and hopefully today was good for people. So,
Hmm.
all right, cool. Well, I'll let you guys run. Good to see everybody, and let me know if you have any thoughts on things that you'd like to see covered on call number 3.
Will do.
All right, see
Talk
you
to you
guys.
soon.
All right,
Bye.
bye.